What's up everybody, this is Yasin and you are watching The Passionate Realtor. In this video, we are going to take a look into CMHC latest housing report where they predicted the market is at the high risk of vulnerability and it may take a major price correction anytime soon. What does it mean in terms of reality check? We are going to take a look into this. So without further ado, let's dive in. This is CMHC fourth report in the last 2 years where they predicted the market is going to crash or take a major price correction since the pandemic happened. And consistently they are missing the ground reality. And I'm not going to blame them because the people who are creating this report are basically the economists who work on theoretical models based upon the data that they get from the economy and then basically create a model where it shows their prediction over the next 2 to 3 years. But just understand, CMHC is a government organization and their whole purpose is to look into the market and make some assessment to give directions to the government so that government can make decisions in terms of, creating different programs for first-time home buyers, creating fiscal policy, work with banks to modify the monetary policy if it is needed, things like that. Now, when we look into the report, the way CMHC predicted this whole scenario is based upon 4 categories. So they created this chart. If you look at that, and you can see there are 4 different buckets the way they made their assessment. Number 1 is overheating. Number 2 is price acceleration. Number 3 is overvaluation. And number 3 is excess inventory. And then they average these 4 categories out to determine whether the market is vulnerable or not. So if you look at the overheating category, the way they calculate the overheatingness in any major city or across the board based upon the SLNR ratio. It's a very famous KPI that all the real estate professionals use it in terms of understanding where the market is heading. Basically what it means is sales to new listing ratio. So how many new listings are coming into the market and are being absorbed. So when they look into the data and they decided, okay, the SNNR has been consistently over 60%, quarter over quarter, which determines the market is overheating. So at a national level, you can see they categorize Canada as at a medium risk of being overheated, in the March and also in September. But across different cities, you can see it's a different picture. From the eastern side of the country, from Hamilton all the way to Halifax, it is considered moderate risk. But then on the western side of the country, like from Winnipeg all the way to Victoria, they think it is on a lower side of the risk spectrum when it comes to overheating. And one can argue, how come Vancouver is at a lower risk of being overheated? Again, the parameter that they use to assess whether the market is overheated or not is based upon SNR, and according to them, the SNR was much higher at the beginning of the year and it's slightly dipping down, as we approach in the fall market. Now, if we look at the price acceleration category, now this is not exactly the house price or average house price. What it means is at what rate the prices are going up. For example, if the house prices have gone up 15% in 2020 and then they increased 30% in 2021, that is a 15% year-over-year growth. Okay, so that's what the price acceleration means. So at what rate the prices are going up year-over-year. Okay, on the other hand, if the price has gone up 15% in year 1 and again 15% in year 2, then the rate of change is 0. Okay, then we think price acceleration is kind of stable. Okay, so at a national level, you can see they think Canada has gone from lower risk to moderate risk because the rate of change of price is still much higher than what we used to see before. And across different cities, again, same picture. The eastern part of the country is showing moderate risk. The western part of the country is showing low risk. Again, one can argue how come Vancouver is in green state. This is their way of assessing it. Okay, so overvaluation category, which means how much the market is overvalued, and they determine based upon three KPIs. Number one, the population, right? Is the population increasing in a particular geography or not? Number two, the interest rate, how easy or cheap the borrowing is for them to acquire new real estate asset. Number three is the disposable income per capita, right? Based upon these three parameters, they can determine whether the property is really overvalued or not in that particular city. For example, if you have a lot of disposable income available within the citizens of that area, and then you have population coming in from outside, and the interest rate is so low, it doesn't really matter if the average house price is 1 million or not, because you have so much demand coming into the city that can easily absorb the high price going across the city. So according to them, the Canada at a national level, it's still at a moderate risk of being overvalued, but across cities, you can see a mixed picture. Pretty much every city shows either low or moderate risk, except Moncton. For some reason, it's way out of the whack. Okay. Excess inventory is the fourth category, which means how much inventory is available to be absorbed in the market. It's kind of linked from the overheating category, but what it shows, if you have too much inventory available, that means you have less demand, which means the market is going to take a dip in terms of the house pricing, because we don't have enough demand to match the available houses in the market. But across the industry, you can see they're seeing a low risk in terms of excess inventory, and except Calgary, which was on a high risk side in the month of March, but it is now shifted into the moderate risk, purely because they may have a little bit better inventory levels now in September. Now, if you average them up, they determine the market vulnerability based upon these four categories. If you have three consecutive moderate risks, then they automatically determine that the market is at a high risk of being market vulnerability. So if you look at a national level, you have moderate risk in overheating, then moderate risk in price acceleration, and then moderate risk at the overvaluation. It automatically becomes a high risk category from market vulnerability perspective, right? And then if you look at other cities, you can see pretty much on the eastern side, from Hamilton all the way to Halifax, except except Quebec, the market is at a high risk of being vulnerable, versus the western part. And you can argue, how come Vancouver is at a low risk of market vulnerability? But again, that's how they made their assessment, and you can see it's purely mathematical, theoretical assessment, not very close to the ground reality. And I can tell you what is ground reality. The ground reality is the inventory is all-time low. We still have people competing for limited amount of houses available in the market. Plus, they did not take into account what will happen when the 400,000 new immigrants will come into this country. That will generate a huge demand of housing, both from rental perspective as well as from resale perspective. Number two, they made interest rate as part of their calculation, but they did not mention why the interest rate is too low. Like we saw, the economic situation in the country is worst, right? We saw the economy shrunk 2.1% in Q2. And when you have struggling economy, the banks are not able to increase interest rate. If they do, it will further hurt the economic growth in the country across all segments. Real estate is one of the major part of the GDP growth in this country, and you cannot punish the real estate growth expecting economy to go up on other side. That's not happening in Canada, at least in the recent history. So think about that. When the economic condition is struggling, interest rate low because they cannot increase it. Plus, one missing piece here is the amount of liquidity being pumped into the market. Okay, you can see, if you have seen my previous videos about this, I have been constantly talking about the Bank of Canada, the central bank, has been literally printing money Since the pandemic happened, they started from 5 billion per week. Now they're dropping down 2 billion per week, but they're still printing new money and pumping into the system. What it does, when the new money created, it is flown into the economy and it's made its way down to the consumer's pocket and then into the transactions, it drives the asset prices up across all commodities, food prices, gas prices, raw material, lumber, steel, and real estate is not an exception here. It drives the asset prices, real estate, stock market, whatever you can think where the money can be spent, it automatically drives the asset prices up. They did not take into account this phenomena, and that is right now going on, and perhaps based upon the economic science, it will continue to happen until and unless the economy starts reviving. And for that, we have to, the country has to work hard really, because they have to increase the export, job market has to be better, they have to increase their tax collection. Once they start increasing the revenue, the exports going up, then the economy automatically goes up. And only then they can increase interest rate and reduce the money printing process. Until then, I don't see the economy is getting better and the interest rate will go up, because as soon as they increase the interest rate, it will start hurting the economy and we will be back into the pandemic situation we just came out with. So, and that's a topic for another video, but I just wanted to make sure that you understand what does it really mean when you look into this CMHC report from reality check perspective. I hope you get some value out of it. If you like it, give me a favor, hit like and subscribe, and then share this video with your friends and families, because I think that information is important for everybody to understand before they make any conclusion or decision about the buying process for their house, whether for personal use or for investment perspective. Until my next video, take care.